Hey everybody, it's been a little while since I had Tyler on the channel. Unfortunately, I got hit harder by the hurricane than we thought. The last time a hurricane actually hit central South Carolina as a hurricane was the 90s. So it's been a little while since we've had to deal with something like this. But other than a big old palm tree sitting on my front lawn down and a lot of branches and crap in my pool, I made it through pretty much unscathed. So I'm very, very thankful for that. Hopefully everyone else is doing okay too. I know a lot of South Carolina fans watch my channel, so best wishes to all of you through all this. But we are back, and Tyler is joining me. We're going to talk about some great ideas for October. Hopefully, you think they're great ideas. I think they're great ideas. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. It's the best way to support this work we're doing. You can get some great stock ideas from the Motley Fool. And again, that link is fool.com/Frankel. So, Tyler, obviously the hurricane didn't hit where you are. He seemed pretty unscathed. How are you doing today?
I mean, I'm pretty good. It's sunny here, and I'm up on the 18th floor, so there's not a lot of chances of trees knocking down and taking me out.
Yeah, flood damage, I guess, is not a major concern for you. Um,
Not yet.
but so, without further delay, I know you aren't a big fan of the one I'm going to talk about today, so I'm going to save that for later. But in the meantime, what is this? I'm actually really intrigued at yours because I like small cap ideas that I haven't really heard of yet. So what's on your mind this month?
Sure. Well, I think in this case, I think we're both really getting our hands dirty here with maybe some value investments or some things that are very much out of favor. And the company that I have been looking at lately is Canadian Solar. Uh, so Canadian Solar is a developer and manufacturer of solar panels. So on the developer side, you can do the development of utility scale solar with attached battery systems. It's called energy storage, but it's basically just a big battery to make it happen. The ticker for that one is CSIQ. Okay, so I said it was a really dirty value play. And part of the reason is over the past year, it's down 32%. Actually, over the past 10 years, it's down 50%. It's solar panel manufacturing, as much as we see it as, or growth in solar panel installations, growth in solar energy, it's still very much a cyclical industry. The growth rate is pretty good, but it constantly goes through periods of over and under supply, and factors of like subsidies and tariffs and things like that can very much swing the profitability of a producer at any given moment. It's kind of a race to the bottom of the cost curve. There's not a lot of pricing advantage that you get from solar panels. They're pretty commodity product. However, that said, 18 to 20% gross margins for solar panel production is pretty good, and it ends up being a profitable endeavor. One of the things that I would say kind of messes up Canadian Solar relative to other panel producers is this development arm that it has. Because when you develop these utility scale projects in house and then sell them to somebody else, you have to hold that entire development on your books, and it generates zero revenue. It's all cost for as long as you're developing it until you can sell it. So it can look pretty unprofitable for a while and then have this giant lump sum payment or something like that. So, lumpy is kind of understating what happens with earnings with this company. Um, and because of that, I think it's a little bit undervalued. A lot of people just kind of look at it and say, "Oh, it's so lumpy and so unpredictable. I don't really want to be a part of this." But this past year, they actually did a deal with BlackRock, where BlackRock invested into its development arm, where BlackRock is going to actually in a joint venture with Canadian Solar hold on to some of those assets as operating and actually operate them. I think it's kind of like a BlackRock's way of like good generating solar tax credits and things like that. And as a result, they'll get a little bit steadier payments holding onto the assets and selling the power under a purchasing power agreement. And, with BlackRock involved, it kind of frees up some of the capital that would typically be involved with this, because BlackRock's going to help finance some of the development of these projects. So you can either own or sell. It makes it a little bit more efficient. Revenue is going to be a little bit more steady. Uh, it's still been growing. I think this past year, I think total panel production is going to be up about 7 to 10%. So we're in a decent growth phase, not great, but that's pretty par for the course for solar panel manufacturing. And the thing that I like about it the most actually is because it's just so cheap. Right now, the shares trade for 0.4 times book value. So basically, it's saying it's trading, like the assets on the books are trading for 40 cents on the dollar. Now, as I said, it's a cyclical business. I don't have any like delusions of grandeur that this thing is going to trade for 2 to 3 times book. That's just not unrealistic. But, trading up to 0.8 times book and still being less than book value would still be a monumental gain on this stock in a relatively short period on a valuation basis. And for a business that I think is doing relatively well, it's not over leveraged, it's still generating some profitability, cash is still coming in the door. I think this is kind of one of those things where the market is mispricing this. And I kind of one of those, yeah, I'm willing to get my hands dirty because I think this thing could have some upside potential here.
Nice. So, yeah, we're both gonna kind of do. These are kind of, well, I'll call them speculative investments at the moment, at least for on the spectrum of what we generally talk about. So the one I'm going to talk about is a company called Nextdoor. I've done a kind of deep dive video on this on my channel not too long ago. Ticker symbol on this is KIND, kind. Nextdoor's mission is to build a kinder world, which ironically the platform is generally used for people complaining about their neighbors and things like that. There's not a ton of kindness going on for the most part, but there is some. Nextdoor has I don't know if you ever saw the Saturday Night Live sketch, but Nextdoor's there is a lot of arguing between neighbors and things on there. But the ticker symbol is kind. Hopefully you remember that now after that little tidbit. Um, the company went public by SPAC during the big SPAC boom, um, and it really wasn't worried about growing, as most companies that went public by SPAC weren't worried about. They had just hired a new CEO, Sarah Fryer, who a lot of people, she was CFO of Square in its earlier days. And a lot of people kind of credit her with building that business when Jack Dorsey was essentially, focused on Twitter. Um, and she did. And now she recently left. Who knows what happened there if she was kind of told to leave or whatever. But Nextdoor's co-founder came back in and took over the business. Now, Sarah Fryer, I respect her a ton as a business leader. She does a great job when she doesn't have a budget. Is the best way I could describe her management style. Wouldn't we all do great if we didn't have a budget, Tyler? But um, so like Square in the earlier days, they were growing so fast, and there was so much potential there. They didn't really have to worry about making money. They had a ton of cash. Now she's CFO of OpenAI, which again nobody really cares about the budget there. There's just so much perceived potential there. But at Nextdoor, when the SPAC boom died down, and all of a sudden it became a focus on efficiency at all costs, pretty much everywhere else in the market. That wasn't the case at Nextdoor. They were still hemorrhaging money. They were still not really growing very fast. Um, just the numbers were not trending in the right direction. So the co-founder recently took over again, and specifically is prioritizing efficient growth. And it's paying off so far. He just took over back toward the beginning of this year. I want to share my screen really quick just to show you one thing. So if you could see this right here, this is revenue growth. The company has not done a great job of monetizing. Obviously, for a tech company, 4% year-over-year revenue growth for 3 consecutive quarters right here wasn't anything that anyone was going to get excited about. But you see, since the management change happened, that is accelerating. Went to 7%, then 11%. User growth is now the highest it's been in quite some time. The user base is as big as it's ever been. In the post-COVID days, pretty much all social media platforms saw active users contract. Nextdoor is now at an all-time high. They're doing a great job of monetizing the platform. And whatever you think about the term adjusted EBITDA, theirs is trending in the right direction. You see they're getting close to break even. The company thinks they are going to be generating positive cash flow starting in the fourth quarter, so the current quarter we're in right now. So things are trending in the right direction. This company is a very cash-rich company because it went public by SPAC. A lot of these companies raised a lot of money. Nextdoor has a sub $900 million market cap and has $457 million in cash sitting in the bank. It has zero debt. and it is still in the early stages of figuring out monetization and really where it fits in the whole social media landscape in terms of making money. For example, they're a very neighborhood focused platform, so they make a lot of sense for people trying to target ads at people in their neighborhood or in their immediate area or things like that. And that they're really trying to boost the efficiency of their ad platform. One great statistic: their revenue per employee is up 50% year over year, just over the past year alone. So that's a great way. You know, they're clearly becoming a more efficient, leaner business management. So there's a lot more efficiency improvements to be had, and if they can even monetize their user base, maybe like a third of what Pinterest is doing, or 1/10 of what Facebook is doing, this would be a multi-bagger stock from here. Their management clearly thinks it's cheap. They're buying back stock hand over fist right now. I mean, it's a very small cap company, and they have half their market cap in cash, so they're spending a reasonable amount on buybacks while it's cheap. The share count dropped by 5% in the second quarter alone, just because this is such a cheap stock. And I like this one. Again, not a sure thing by any means. I would call this even a more speculative name than Tyler just talked about. Um, but if they can execute, kind of like he said, if they can execute, this could be a big win for shareholders. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.